What's up guys, Ben Samilak here. In this video we are going to show you what kind of taxes you have if you're a trader. I have a lot of people when they ask me about, they're going to get into trading, how much is taxes on stock, how much tax do I pay on futures, and what's now with crypto in the game, there's a whole nother beast with that. So check out this video. We got the Guardian voice. He's going to be breaking down in a cool little PowerPoint all the different taxes you'll be paying if you're a trader. And the good thing is, no one likes to pay taxes, but if you're paying taxes, that means you had a profitable year in trading, which is always a good thing. I always say that, and people always want to ask me, how can I save money on taxes, Ben, as a trader? There's a lot to that, but on the positive side, if you're paying taxes, that means you made money, which is always a good thing. So check this video out, this PowerPoint. Hopefully it helps and you guys enjoy it. Have a great day. See you next time. Bye.
Good morning and welcome to another episode of Faith and Finance. Today is Tuesday, February 18th, 2025, and today's topic, taxes. So I want to get started here. Looking forward to sharing with you some information on taxes. So again, we want to welcome you. We're glad to have you here with myself, the Guardian Voice, your host, and my co-host, Mr. Ben Samulak, the Guardian Angel. So we do have a disclaimer, just in any business endeavor and in investing opportunity in trading included, and everything in between where you are looking at the management of capital and risk management, uh, there can always be a result in loss, and you need to know that. Any business or investment decision is a personal decision and should only be made after thorough research, including a personal risk and financial assessment, and the engagement of professional assistance to the extent you believe it necessary. Again, we are for educational purposes only, and we truly want to help you reach your goals and objectives when it comes to your finances. So, to get today's episode again, tax strategy. As a U.S. citizen, paying taxes on your earnings from trading futures, forex, crypto markets, this can be complex as each market has its own tax treatment. And what I'm going to do is I'm going to break it down of how taxes work for each one of these asset classes. Just a short, brief defensive tax strategy. I know it's February. We're getting ready to do our taxes. A lot of times you haven't even thought about this during the year. So this should definitely help those of you that have been trading this past year and didn't even think about taxes. I've been there. And long story short, on that note, I remember I traded the futures market and was very profitable. And I wasn't even thinking about taxes. I spent the money and I didn't have it set aside. And the following year, I had a tax notice. So you don't want to make the same mistakes that I made, and hopefully this will help you prepare for your tax obligation. Okay, so let's get to it. Futures trading. Uh, Futures are classified futures contracts when you're, trading the S&P index or the softs, corn, wheat, soy, or your interest rates. These are classified. Futures contracts are generally considered what they call Section 1256 contracts under the U.S. tax law. So the tax treatment is very interesting when you trade futures. 60% of your gains are taxed long term and 40% short term, and that's at the capital gains tax, regardless of how long you hold the contract. So if you hold the contract for a few days, a few minutes, a few weeks, a few months, you have the benefit of taxing 40% short term and 60% at a long term tax rate. And that long term rate is lower. The long term capital gains rate ranges from 0 to 20%, depending on your income and your tax bracket. And then the remaining 40% is taxed at the short term rate. Your ordinary income tax for short term taxes is a lot higher, and it can be as high as 37%. Now, if you are eligible to trade as a business and you've been set up an LLC or an S corporation or a C corporation, and you know who you are if you have, you can trade with what they call the mark to market uh, method. And at the end of the year, the IRS typically for all of us marks to market your futures positions, meaning they treat your open contracts as if they were sold at the year end. So, like, let's say you were long the S&P December 29th, and you didn't close that, and you wanted to hold that open until 2025. Well, they're going to mark to market on those positions and calculate it as if you closed that position fiscal 2024, not taking it into the new year, if that makes sense. So you report your futures gains and losses on IRS form 6781. Take note of that. Next asset, forex. When I was new to trading, I love forex trading. It's usually treated as either, again, a section 1251 or 1256 contract. And the 1256 portion, if you trade futures, you know that you can trade currency futures. You can trade the yen, or you can trade the euro. Um, or if you're a pairs trader, it's called spot foreign currency trading. So currency trading comes into two categories, and most individual traders fall under the latter, or spot foreign currency. So that's for those of you forex traders on forex.com that trade the major pairs. Those are the spot pairs. Now, how are these taxed? Um, Again, Section 1256 contracts we covered. If you trade through the futures or forward contract, that's the 60-40 split. But with spot forex trading, you forex.com traders, Oanda, um, interactive brokers, if you're trading on IB, just if you're trading the pairs, you are directly buying and selling currencies and is treated as ordinary income for tax purposes. So your gains or losses are taxed as short-term gains, regardless of how long you hold the position. So it's pretty simple. They're all going to be taxed as short-term capital gains based on your ordinary income. And that's based on your total aggregate, income, ordinary. So that can be W-2 if you have a job and you're trading, or any other income source. You calculate that together and you include that, and that number uh, with your forex trades is the dollar amount that you're taxed at, but your forex trading set aside is taxed as short term. Okay. And you report your Forex gains on Schedule D, and that's Form 8949. And any gains from currency futures, again, will follow the rules for Section 1256 contracts, Form 6781. So, again, that's for you futures traders that trade the euro independently of the pair, the yen independently. And if you trade futures currencies, you know what I'm talking about. And I'll go to Schedule D and Form 6781. So, and then crypto trading. Crypto trading now is going to be, it's here, and it's going to be definitely more, it's more popular. It's going to be a part of the future because it's a new asset class. Now, how is this new asset class being classified? Cryptocurrency is treated as property by the IRS, similar to stocks or real estate. So your capital gains tax when you trade or sell or exchange a cryptocurrency, you are liable for capital gains taxed on any profit. So it's either short term if held for less than 1 year, or long term if held for more than 1 year. Also, in the world of cryptocurrencies and crypto trading, you can mine or earn crypto. If you mine or earn cryptocurrency as income, that amount is taxed as ordinary income based on the fair market value at the time you receive that cryptocurrency. So again, it's added to your ordinary income, and you have to look at the fair market value at that moment in time. airdrops and forks. If you receive crypto through airdrops or forks, the IRS treats this as income at the fair market value on the day you receive it. So some of the cryptocurrencies allow you to hold almost like a CD or rewards for not selling for a period of time. They pay you an amount after a duration of time. That amount that you're paid at that duration in time is added to your ordinary income at its fair market value. And so you report this, you report your crypto transactions on forms, IRS Form 8949 and Schedule D for capital gains, and that's for selling your positions, and possibly on Schedule 1 if you have income from mining or other sources. So if you are engaged in that type of activity, you know who you are, and then we highly encourage you to reach out to a tax professional. On that topic, I will say this, you know, we're not endorsing one company over another, but I know that if you want to pay for a reliable provider, H&R Block is very well known. It's an industry standard, and they do charge a fee. Also, Intuit or TurboTax, I would, in my humble opinion, that's for people that are more do it yourself and would like to take on that task. Also paid for service. You pay to access their website and load the information. Those are just two general recommendations that are common US-based companies that help you with your tax. And then you can also consult your tax professional if you hire someone, an accountant or someone that is certified to do taxes professionally. Additional considerations, you have tax loss harvesting. So just like with stocks, you can offset gains with losses. And this is for your investment, your total investment activity. So if you have losses in one market like futures, you can use those losses to reduce your taxable income in another market like crypto. So again, it's just adding all of your gains and losses from all of the different asset classes, putting them to pen and paper, and then knowing the totals. This is the total gain, my total loss number, and you can, apply your losses against your gains. So just a quick math illustration. Let's say you have $50,000 in gains, $10,000 in losses. Those $10,000 in losses were from a combination of forex, futures, and crypto. So you technically can take that $10,000 in losses and reduce your gains by $10,000. And so instead of $50,000 in gains, you have $40,000 in gains. And that's just a simple mathematical illustration that I've shared for educational purposes. Self-employment taxes. So if you're trading as a business, if you're a day trader or someone that does trading as a primary source of income, and again, you know who you are, you may be subject to self-employment taxes because you now are responsible for paying Social Security and Medicare to the IRS. Did you know that? A lot of people don't know that. So you would report this on Schedule C, and if you're trading as a business, you may also be able to use more favorable accounting methods. And I talked about mark to market earlier. And really what mark to market allows you or enables you to do is write off losses beyond a $3,000 limit that most of us as individual taxpayers are limited to. See, when you're trading as an individual, you can't write off an unlimited amount of losses. You can only write off approximately $3,000 or so worth of losses. So that's important to know. Estimated taxes. If you're making a substantial amount of income from these markets, and again, we live, you guys, in a progressive tax system. So throughout the trading year, if you're making money throughout the year, you may need to make estimated quarterly tax payments to avoid penalties. Also, here's another nugget. I am going to research myself, but crypto tax software for crypto traders, there are several software tools that are coming to market. We have coin tracking, TaxBit, or Coinly, and they can help you track your cryptocurrency transactions and calculate your gains and losses. Because with the airdrops and the forks, that can be cumbersome and pretty detailed. So there are service providers. I mentioned, like I said, H&R Block and Intuit. And for crypto trading and cryptocurrencies, these were identified for those markets, and that's coin tracking, TaxBit, or Coinly. So in summary, just again, for futures, you report on Form 6781. They're taxed with a 60-40 split for long-term and short-term. With your Forex trading, your Forex traders, spot Forex traders in particular, those guys and gals that are trading Forex pairs, you tax those as ordinary income. They're short-term. The futures contracts that you're trading are taxed like futures. So again, you know who you are if you're trading futures contracts. And then crypto, those transactions are treated as property and they're taxed on capital gains, either long-term or short-term, if it's a year or more. So the holding period is what's really important. And you also are taxed on income if it's earned or mined. Since tax laws can change and nothing is constant but change, and there are nuances that can affect how you're taxed, especially for you guys and gals that are trading frequently. And if you're engaged in business level trading, it is definitely advised to consult with a tax professional who specializes in these markets for guidance on your specific situation. Make sure you hit that like button. This has been another episode of Faith and Finance. Please subscribe to the channel. This is your host, the Guardian Voice, and my co-host, Mr. Ben Samulak. I'd hit that subscribe button and make sure you share the episode with someone that's trading the markets and may need some help with taxes. We definitely want to help all of you traders. Remember, plan your trade, trade your plan, and always keep God in it. On that, we will close. Dear God, we thank you for the opportunity to share this timely information. Oh, dear Lord, we know that many of us are preparing to do our taxes, and some of us may have not even considered our trading when it comes to tax preparation and planning. And we're thankful and grateful that we're able to share this information to help those that may have not been aware of the taxes. And the scripture teaches, render unto Caesar that which belongs to Caesar. Take care, traders, and have a great rest of your day.